The US economy is losing steam. Sluggish global activity as well as President Donald Trump's trade war with China have dampened growth in the second quarter. However, consumers' willingness to take out their wallets has propelled expansion beyond analysts' expectations. Second quarter GDP has risen 2.1%, marking a sharp decline from the 3.1% in the previous 3 months. One area of weakness is business investment, which has contracted for the first time in more than 3 years. Consumer spending, which accounts for more than 2/3 of the US economy, has grown by 4.3%. That's up from a paltry 1.1% in the first quarter, and its strongest jump in 5 years. Together with solid gains in jobs and wages, it's helped offset slumping exports and the negative impact of the year-long tariff dispute with China. Many companies are hesitant to invest, preferring to wait and see if the two countries can resolve their differences. The stimulus effect of Washington's tax cuts of $1.5 trillion is also fading. The Trump administration has argued that reducing taxes would help boost growth to 3%, a target it missed last year. Boeing is also dragging on the economy. The plane maker has posted its biggest quarterly loss in history. Its money-spinning 737 MAX jet has been grounded worldwide since March after 2 deadly crashes within 5 months. Deliveries have dropped by more than half, while costs keep rising. The Federal Reserve is widely expected to reduce interest rates next week for the first time in a decade. But strong consumer spending has dimmed forecasts of a 50 basis point cut.
I'm questioning the wisdom of the Fed cutting rates at a time where, the US economy is slowing a little bit, but only from 3.1 to 2.1%, and at a time when stock markets are at record highs.
The GDP results are unlikely to make much difference in the Fed's decision. But they are hard evidence that President Trump's trade war with China is weighing on US economic expansion. Sibel Karkus, TRT World.
Well, for more on this, Daniel Ryntjes joins us now from Washington, D.C. Hi, Daniel. Now, the latest GDP figures, as we know, were better than expected, but they still mark a slowdown in the world's largest economy, don't they?
Not a slowdown. I mean, this is still a very healthy rate of growth, 2.1% in such a large economy. And that was largely reflecting the fact that American consumers have been reaching into their wallets. I think consumer spending rose by about 4.5%. And the reason that's so important is it represents about 2/3 of the entire makeup of GDP. So it's important that consumers are still feeling in the mood. Unemployment is at a very low level and paychecks are coming in better than expected. But there is a large question mark hanging over businesses' mood. They see problems in the global economy largely caused by this tension between the US and China that is unresolved, and they have been reluctant to invest as a result of that, and that's why the GDP number has come down by a full percentage point.
Yes, and what's the current state of those trade negotiations between Washington and Beijing? We know that talks stalled for a moment there, but are there signs that they're going to get back on track?
Well, they stalled in May because of fundamental disagreement about the nature of the agreement that they finally would sign. We are told from the Washington side that China came back on a draft agreement that would have meant really penetrating changes in the nature of Chinese law and the way it runs its economy, for example, in the area of state-owned enterprises. So it's unclear at this stage whether there is a compromise between those two sides. And for now, the White House is really playing down expectations, saying only that these talks could give rise to the Chinese agreeing to buy somewhat more agricultural products as a move to try to improve the atmosphere. But at this time, it's unclear whether they are, in fact, going to be able to breach these very large disagreements in the way that Washington has been demanding changes to the structure of China's economy.
Now, in responding to the latest GDP figures, the US President Donald Trump tweeted essentially laying part of the blame on what he described as a very heavy weight of the Federal Reserve anchor wrapped around our neck. This was Donald Trump's words. Now, does this add, do you think, further pressure on Jerome Powell to cut interest rates when the US Fed meets next week?
Well, I think your earlier clip from the analyst is quite coherent in terms of economic thinking, which is that whilst the US economy is still in a healthy pace, you'd be reluctant to reduce interest rates because, in a sense, you want to keep your powder dry for a time when the US economy is actually struggling. And then when you reduce interest rates, then it has a more notable effect on economic growth. So I think to some extent the Federal Reserve has acknowledged that there may be a need to slightly reduce interest rates at the next meeting, and most of the markets are expecting that to be the case. The probabilities are 80%. But there's much uncertainty about what will happen after that, whether there might be another quarter point reduction or anything beyond that. So I think, yes, to some extent, the Federal Reserve has been under pressure from Donald Trump. But at the same time, the impact is likely to be limited while the US economy continues to be in a fairly healthy pace.
Yes, and one of those factors behind, I guess, the US economy's continued expansion are these positive jobs numbers as well. We know unemployment has hit record lows in the United States, but can you tell us what other positive indicators are there in the US economy at the moment?
Well, I think that the fact of the mood of the consumer at the moment is so strong. As I say, it represents about 68% of the entire makeup of GDP. And much of that is obviously driven by the fact that Americans feel secure in their jobs, and they're even getting rises in their paychecks, which, despite this, longest period of economic growth in US history that happened in July, we marked that point. Despite that, there had not been very many rises in paychecks over the preceding years. So that's why I think the consumer part of this is so important. But I think it's very, very important to note that businesses themselves are feeling much more reluctant to invest. They are concerned about the uncertainties created by the Trump administration's policies on trade. And in fact, the trade numbers themselves showed an increase in imports into the United States and a decrease in exports from the United States, acting as a drag on GDP going forward.
Okay, Daniel Ryntjes, we'll have to leave it there, but thank you again for your time.